Welcome to Cup of Bowl. My name is Michael Dunham. I'm the Director of Planning here at Fontana Financial Planning. And with me today is Patrick Fontana, the founder of Fontana Financial Planning. Welcome.
Cheers, Michael.
Cheers. Patrick, today I want to talk about charity. And so the question that I have for you that I'd like to pose is, what are the best ways that somebody listening to this can give to charity tax-wise in 2025?
So I am thinking one of the things that's, age dependent is part of it, income's dependent is part of it, and what you're holding in your portfolio is part of it. So there's different answers depending upon where you lie, right? So I will say, first off, anybody that's 70 and a half and has retirement money, there's low hanging fruit there to take money from your retirement account, give that to charity. Then you don't pay the taxes. Charity still gets the same money. It's a pretty awesome strategy.
Yep. And with that, so once you turn 73 or 75, depending on the year that you were born, you'll be required to take what's called a required minimum distribution every year. One of the nice things about these qualified charitable distributions, or QCDs, is any money that you gift out of your IRA also counts towards whatever that required distribution is. So if your required distribution is $30,000 and you gift $10,000 directly to charity using a QCD, you only have to take $20,000 as a taxable distribution.
Next thing that comes to mind is when you look at your holdings and you have appreciated stock. Say Amazon you bought for $1,000 is worth $10,000. Rather than giving cash, to take the appreciated stock and give that to the charity. If you look at the tax rates right now for 2025 and you see where you are in the tax rates, the more money you make, the higher up you are, the bigger the tax break that you get for doing that. If your income is not going to change between now and next year, it may be worth considering and seeing, is it a more valuable thing to do in 2026? Now, we don't know where the tax rates are going to end up, but that makes some sense to consider.
Yeah. And what I'm a big fan of there is, a lot of times what we see is people maybe give $5,000 or $10,000, which is a lot of money to give to charity. But when you add that against all of the other itemized deductions that they may have, and then you compare that to the standard deduction, a lot of times people are not eclipsing the standard deduction. $30,000 for a married couple is the standard deduction for 2025. And so it's a pretty high hurdle to eclipse before you start getting a tax benefit for the charitable giving, the mortgage interest, the property taxes, or state and local taxes that you may be paying. And so one strategy that we're big fans of is, if you're kind of in that, you may call it like a no man's land zone of charitable giving, we're big fans of doing what's called a bunching strategy, where maybe we bring forward 2, 3, 4 years worth of charitable giving all into 1 year. And we use what's called a donor advised fund, or we call it a foundation account, as a way to be able to lock in the itemized tax deduction in 1 year, and then have the money invested and grow, and ultimately dole it out to the charities that you may have otherwise done so. And then, to your point, that standard deduction of $30,000, if our government does nothing and tax rates sunset at the end of 2025, in addition to tax rates changing, the standard deduction is also set to go in half. So $30,000 is the standard deduction amount for a married couple this year. That would become $15,000 next year. And so, to your point, that's where it may make sense, given the overall tax situation for an individual person, to say, hey, instead of doing a charitable gift in 2025 where I may get no tax benefit, maybe it makes sense to do that gift and maybe even bunch a few years of giving in 2026 when you have this lower hurdle to eclipse.
So other than charitable contributions, what things count towards that standard deduction?
So for most people, there's really 3 components. So 1 is charitable giving, 2, mortgage interest, and then 3 is what's called state and local taxes. So here in Texas, it's largely property taxes. People that are on high income states like California, New York, it includes any state taxes paid. Right now, that's capped at $10,000. So there's a SALT cap limit of $10,000. That is another thing that is set to sunset here at the end of 2025. So if you're in a high tax state, California, New York, wherever it may be, where you may be limited on your itemized state and local tax deductions to 10,000, you may get a significantly bigger state and local tax deduction starting next year that can increase the benefit that you get from your charitable giving as well.
So to plan and take advantage of the situation and what the rules are, it might make sense if somebody knows I'm going to make more money next year than I am this year. I may be tempted to say, let's do the charitable contribution next year. And if the tax write-off situation for property taxes and mortgage interest and those things changes, I may want to wait to January to pay my property taxes when I could pay it in December. I could pay it in January. And then the following year, looking ahead, you could even pay the next year's property taxes in December and really load up all these things to hit the top level.
Yeah, exactly. The way that I like to look at it is the goal is to get your itemized tax deductions in the year that you're going to have the highest incomes, because that's how you get the most bang for your buck. So I'll have maybe some more flexibility when it comes to itemized deductions next year, but also if we're going to be in a higher tax bracket one year versus the next, that's the better year to maybe do a bunching strategy. So another common example that we talk through with a lot of our clients who are kind of nearing the end of their careers and trying to decide, how much longer am I going to work and how do I get the biggest bang for my buck as far as tax deductions are concerned before I stop working. This is a conversation that we'll have where, let's say somebody plans to give $10,000 a year to charity, and that's kind of, they've got their charities that they like to support, and that's kind of the number that they would like to give to charity every year. And let's say that individual is 60 years old and plans to work for 2 more years, and then their income is going to drop significantly. Well, one thing we may do is we may say, hey, let's pre-fund the next, call it 10 years of giving over the next 2 or 3 years that you're working while you're in a much higher tax bracket. Let's fund a foundation account with your most appreciated stock over those next couple of years. And then we're essentially creating a runway that they can use to give the $10,000 a year to the end charities until they reach age 70 and a half.
They're bridging the gap until they can use their retirement account, which is in some ways the best place to do your gifts from and not pay taxes on it. So waiting till 70 and a half, you line up that bridge the gap, and then get to QCDs.
Exactly. Patrick, thank you for joining me today. How do you want to finish today's episode?
I got a different one today, slightly different. Let's say rebalance with discipline.